Welcome back to the deep dive. Today, we're really getting into the details, cutting through the noise on Affle 3i Limited. You might remember them as Affle India Limited.
Yeah, that's right. And we're focusing specifically on their latest numbers, the unaudited financials for Q2 and the first half ending September 30th, 2025. So that's H1 FY 2026.
We've got the board meeting outcomes, the auditor's review reports, that's Walker Chandiok & Co. LLP, and really importantly, their earnings presentation. And our goal here isn't just, reading out numbers. We want to understand what's behind them. What do they tell us about where Affle 3i is heading, especially with their AI focus?
Exactly. It's about quickly grasping their financial health, looking at those key performance metrics, particularly around their core cost per converted users model,
Right.
and seeing how this whole 3i vision, authentic, actionable, and augmented intelligence, is actually playing out in the real world. Is it making a difference?
Okay, let's dive in. Segment 1, the financial landscape. Starting high level, the consolidated picture for the first half, H1 FY 2026 compared to last year. What are the headlines?
Well, the headlines look pretty robust. Revenue from operations for that half year reached INR 12,675 million.
Okay.
That's a growth of 19.3% year over year, almost 20%.
That's pretty solid growth, especially considering, the potential volatility in digital ad spending.
It is solid. But what caught my eye even more is what's happening further down the P&L. This wasn't just growth for growth's sake. Meaning their reported profit after tax, the PAT, it grew even faster than revenue. It clocked in at 21.0% growth year over year.
Okay. So revenue up 19.3%, but profit up 21%. That difference, that's key, isn't it?
It really is. It's that first signal of scalability. When profits grow faster than revenue, it suggests the underlying business model is becoming more efficient. They're getting more profitable on each bit of revenue.
Right. So let's dig into that efficiency piece, the margins, because that seemed like a really compelling part of the story here.
Absolutely. I mean, the operating margin improvement is probably the standout element in this whole report for me. H1 FY 2026 EBITDA that came in at INR 2,858 million.
Okay.
And that number jumped 31.2% compared to last year's first half, a really significant increase.
Whoa, 31.2% EBITDA growth. That's way ahead of the revenue and even the net profit growth we just talked about. What does that tell you?
It tells you they're getting much better leverage. They're squeezing more operational profit out of their revenue base.
Yeah.
Look at the EBITDA margin.
Yeah.
It expanded significantly. It hit 22.6% for this first half, H1 FY 2026. That's up quite a bit from 20.5% in H1 last year.
So nearly a 2 percentage point jump in EBITDA margin. That's substantial.
It is. It could be leveraging fixed costs, maybe optimizing their tech stack, or perhaps it signals some pricing power because their AI model is standing out. It points towards a sustainable, scalable structure.
And this isn't just paper profit, right? What about cash flow?
Good point. The consolidated cash flow statement confirms it. For H1, net cash generated from operating activities was over INR 1,831 million, so solid operational liquidity.
Which means they have the cash to fund that AI strategy without necessarily needing tons of external cash for just running the business day to day.
Precisely. Now, just a quick technical note for everyone listening. These results are unaudited. They have undergone a limited review by the auditors, Walker Chandiok.
Right, and the auditors always point out a limited review isn't the same scope as a full audit. That's standard for quarterly reporting.
Exactly. It's just context, not a red flag. The headline takeaway remains strong. Robust margin expansion and good cash generation from operations.
Okay, so the financials paint a strong picture. Let's move to segment 2 and talk about the engine driving those numbers. The core business model, specifically those CPCU metrics.
Yeah, if the financials are the cost per converted user model, CPCU is the how. This is fundamental to Affle.
Explain that a bit more.
They don't really focus on things like ad impressions, which can be, a bit vague. They focus on delivering actual outcomes for advertisers. Someone installing an app, making a purchase, signing up for something, conversion.
And this outcome-based model it's basically their entire business, isn't it?
Pretty much. The documents state that the CPCU business accounted for a huge 97.7% of their revenue from contracts with customers in Q2 FY 2026.
Wow, 97.7%. That's near total concentration.
It is. And, that raises a question for you listening. Is that level of concentration a risk? If market conditions or, say, privacy rules change dramatically?
Or does it show incredible confidence and focus on a model they believe is durable because it's tied to results?
Exactly. Affle is clearly betting on the latter. They believe in that outcome-led approach.
And looking at the scale they're achieving, you can see why they might be confident. Let's talk volume.
The numbers are big. The platform delivered 10.9 crore. That's 109 million converted users just in Q2 FY 2026.
Okay. And how does that compare?
That's a 15.0% increase compared to the same quarter last year. And for the full first half, H1, they delivered 21.6 crore converted users.
216 million conversions in 6 months? That's massive, especially when you think about their total for all of last year, FY 2025, which was around 393 million.
Right, so they're maintaining a really strong growth rate, even on top of that already large base. It's scaling significantly.
And are they having to discount heavily to get that volume? What's happening with the price per conversion?
That's another interesting point. The average CPCU for the first half actually increased slightly. It was INR 58.0, up a little from INR 57.1 the year before.
So pushing huge volume and maintaining, even slightly improving, the value per conversion. That's efficient scaling.
It really is. Now, zooming out a bit, while the model is concentrated, their risk seems diversified in other ways, markets and industries.
Right. The growth is broad-based geographically.
Yeah, the H1 revenue split shows a strong base in India and emerging markets. That's 73.1% of revenue.
Yeah.
But developed markets contribute a healthy 26.9%.
So a good mix of high growth potential and presumably higher value developed markets.
That seems to be the strategy, balancing growth and value across geographies.
And what about the types of businesses they serve? The verticals?
This is crucial for resilience. They state that 100% of their revenue comes from what they categorize as resilient industry segments, EFGH.
EFGH. So that's e-commerce, fintech, gaming, and health tech.
Correct. Think about those sectors. For them, advertising isn't just nice to have, it's often tied directly to acquiring users, driving sales, measurable performance.
So if the ads don't convert, the clients essentially don't pay under the CPCU model. That alignment makes the revenue stream inherently more stable, even in downturns.
That's the idea. It aligns Affle's success directly with their client's success, making it less discretionary.
Okay, this brings us nicely to segment 3. We see the strong results. We see the CPCU model driving it. Why is it working so well? Why are margins expanding? This is where the Affle 3i vision and their tech advancements come in.
Exactly. The 3i vision is authentic, actionable, and augmented intelligence. This isn't just marketing fluff, it seems. It's their stated roadmap for achieving what they ambitiously call powering 10x decadal growth.
10 times growth over a decade. Wow.
Yeah, it's ambitious. And they're explicitly pinning that on developing and deploying proprietary Affle AI.
And the CEO's comments highlighted some specific things, right? Not just vague AI talk. They're enhancing their hyper-contextual creative engine.
Which basically means making the ad creative itself smarter, more tailored to the user and the moment.
But the really big announcement was this thing called Nico.
Ah, yes, Nico. This is where they use the term AI agentic capability.
Mm-hmm.
Think of Nico less like just an algorithm and more like a specialized autonomous AI agent.
An agent, meaning?
Meaning it's designed to proactively work on behalf of marketers to automate and drive app growth, specifically within the iOS ecosystem.
iOS Apple's ecosystem. That's a notoriously tricky but very valuable market to succeed in, especially with privacy changes.
Exactly. So building a dedicated AI agent to tackle growth specifically on iOS that shows real strategic focus on a high-value problem.
And they're backing this up with intellectual property.
They are. The sources mention a global tech IP portfolio, 36 unique patents. 16 are already granted, 20 are filed and pending. They're building a technological moat around these capabilities.
Okay, let's make this tech talk more concrete. The presentation had some case studies, right? Real-world examples.
Yeah, 3 really interesting ones. First, back in India, with Policy Bazaar, the big insurance and finance marketplace.
What did Affle do there?
They used what they call a full funnel strategy. Things like search recommendations, app recommendations appearing right on the user's device, and delivered over 150,000 conversions in just Q2.
So influencing users at key moments when they're actively looking for financial products? High intent.
Exactly. High intent, likely high lifetime value customers. Then jump over to the US with Fetch, the rewards app. This one involved connected TV, CTV.
Ah, the TV screen. How did they connect that to mobile results?
This is clever. They build a bridge using smart QR codes shown in the TV ads. Scan the code, and it connects the TV view directly to an action on the phone.
Okay.
And the result. A reported 58% quarterly growth in new user signups, comparing July-August to the previous quarter. That's huge.
And it solves that classic attribution headache. Did the TV ad actually drive the app install? The smart QR code provides that link.
Precisely. It shows how their tech can bridge different screens and prove value, which supports that CPCU model.
Very smart. And the third example?
That was from Brazil, with the retailer Casas Bahia. They saw over 20% growth in conversions, specifically among premium iOS users in Q2.
Again, with iOS, how did they achieve that?
Through really granular optimization. They adjusted campaigns based on sales seasonality and used day parting.
Day parting.
It's essentially smart scheduling, making sure the ads hit at the times of day when that specific iOS user segment is most likely to be active and ready to convert, factoring in local behavior patterns.
Yep.
Very nuanced to execute.
Got it. Okay. Before we wrap up and think about the future, just a quick housekeeping note on their financing, since the documents updated that.
Right. Quick summary. As of September 30th, 2025, they've used a good chunk INR 5,302 million of the money raised from their earlier QIP, Qualified Institutional Placement. The rest is safely parked in deposits.
Okay.
Same story with the funds from the preferential allotment to Gamma at Pete. LTD largely utilized, balance in deposits. Basically, they seem well capitalized to pursue their strategy.
And there was that note about the stake in Bobble.
Ah, yes. Talent Unlimited Online Services, which runs Bobble AI Keyboard, their 24% stake is still classified as held for sale. They're waiting for updates on inspection rights they're seeking. It's carried at about INR 1,346 million on the books.
So potentially an asset they might divest to focus capital on the core AI stuff?
Seems likely. Keeps the focus tight.
Okay, so let's pull all these threads together. What are the main things you, the listener, should take away from this deep dive? First, financially.
Financially, Affle 3i showed a really strong first half of FY 2026. The key theme was margin-led growth efficiency gains outpacing revenue growth. Very healthy sign.
Second, the core CPCU model, that engine.
It's firing on all cylinders. It's not just stable, it's scaling massively from a 21.6 crore conversions in 6 months while holding onto its pricing power. And it's well diversified across resilient sectors and global markets.
And finally, the strategic direction.
It's unambiguously AI-driven. The 3i vision, the investment in things like the Nico agent specifically for iOS, the patent portfolio, it all points to building a sustainable competitive advantage based on proprietary algorithms.
Which brings us to that final provocative thought we like to leave you with.
Right. Think about this. You have this massive scale, hundreds of millions of conversions, combined with this intense focus on building specialized autonomous AI agents like Nico. What does that really signal?
It feels like they're moving beyond just optimizing ad campaigns.
I think so. It suggests a shift towards actively automating significant parts of the customer acquisition journey, especially in challenging but valuable ecosystems like iOS.
So the question for you to chew on is, how does the rise of these specialized AI agents built not just for efficiency, but designed to actively penetrate and defend territory within specific digital ecosystems, how does that fundamentally change the game?
Is this the new competitive landscape for consumer intelligence platforms? A move from just having a good platform to deploying the smartest, most effective algorithmic agents to win territory.
It feels less like traditional ad tech competition and more like algorithmic warfare for consumer attention and conversion.
That's a strong way to put it, but yeah, it's definitely a battle for computational dominance in this space, a key trend to watch.
Absolutely. Something to keep digging into. Well, that wraps up our deep dive into Affle 3i Limited's H1 FY 2026 results and their strategic vision. Hopefully this gave you a much faster understanding.
Until next time, keep analyzing the future.